Hi, my name is Jordan Wilson. Today we'll finish up our look at investor profiles with the time horizon. Now we've covered time in many previous sections and we'll cover time in many more. But it's important to make sure that you factor your time and your age and the phase of your life cycle into your profile because that has to feed your target asset allocations and your investments. So let's take a look at time. Let's look at time horizon versus 4 different factors. And we've covered most of these before, so I'll keep this abbreviated. The first is investment risk. Previously, we've seen how time impacts the amount of risk that you can assume in an asset. The more time you have, the more volatility that you can handle in an asset. And we saw that with the standard deviation. If I have an asset whose expected return in any given year is 10%, and its standard deviation, its measure of risk, is 2, that means 95% of the time in any given year, the return on that asset will be 2 standard deviations away from the mean. So if the mean was 10, standard deviation 2, we're talking maximum return of 14, minimum return of 6. So if you need to liquidate that asset for some reason, or you need to have some certainty of returns, you know that it's going to be close to 10%, 95% of the time. Whereas if you have an asset even with an 8 standard deviation, then that's a little bit riskier. You might have a return in any or 95% of the years of up to 26%, or you might have negative 6%. If the standard deviation is 15, you might have a return as high as 30 plus 10, 40, or negative 20. So the longer the time period, the more you'll get that regression over time to the average. But in any given year, you have that volatility risk. So the shorter the time period, if you want to reach a near-term goal, then you want to reduce risk so you've got that certainty, that safety. We also saw that with portfolio funding. If you delay your investment 1, 5, 10 years, you either have to increase your risk and or increase your periodic funding because you can't go back and get more time. The maturity of an objective is also important to consider. You might have a long-term investment objective, say retirement in 40 years. For that specific objective, you can take on more risk because it's a long-term time horizon. Your child's university education in 15 years, medium term. You can take on more risk, but you have to be cognizant that that 15 years is now literally on the clock and it's approaching rapidly and it will be a near-term objective soon. So you want to be able to adjust relatively quickly on that from maybe less liquid assets and higher risk and higher return to more certainty as you reach that 15th year. Same with near-term objectives, such as a new house in 2 years. That's a short-term time horizon, so you want to have increased certainty. You want to have liquidity. You want to have safety of capital so that you can finance that new home. Individuals, time horizon will differ between them, obviously with their objectives, but also just with who they are as people. And we'll look at an example of this, or we'll look at the phase of life cycle theory of wealth accumulation in a couple of minutes. But that's also a problem with the cookie cutter approach. And by cookie cutter, what you might see is there used to be a popular way to invest. You take your age, you subtract it from 100, and that's the amount of assets that should be allocated to equities. Now, there's probably 5 or 6 different things wrong with that approach, but one of them is that if I'm 40, then I would say 60% equities, or if I'm 30, 70% equities. But a 30-year-old me is not a 30-year-old you. And that's the life cycles that differ between people, and we'll get into that. Again, I pull up this slide that I did in the investor constraints section. So you can just sort of see visually the impact of time versus risk versus funding, and how if you delay or your time horizon shrinks, you either have to take on increased risk or you have to take on increased funding. And if you look at the risk, it's probably not reasonable that you're going to get 63% return per annum for 10 years. So there's kind of a cap, a realistic cap on the amount of prudent risk you can increase in a portfolio to compensate for delayed investing patterns. Similarly with the funding, and again, we talked about this in the constraint section, but if you have $6,000 a month lying around, $72,000 a year to invest for 10 years to get to your million, you probably don't need to save that $1 million. That money's lying around, you probably have adequate assets elsewhere. The issue is that people that couldn't afford or didn't have the desire to invest for retirement in their youth or their younger years, and they waited until the last 10 years out, they probably won't have $6,000 a month of free cash flow sitting around. So again, there is a practical cap on the ability to fund. And I think the key takeaway here is even if you can't invest a lot, it's always better to start as soon as possible and let the compound returns grow over time. Now we get into the life cycle phase, and this is really the only thing I wanted to talk about today, other than the fact that time is obviously a huge consideration in one's investor profile. But the life cycle phase reflects how people are different. And a classic example, maybe a bit stereotypical, is you come out of high school and you apprentice to be a plumber or an electrician. Within a few short years, you're actually out making good money. And because you didn't go to a 4-year bachelor's program at a university, you probably have no debt relative to someone that did. In that scenario, if you have 3 people, let's say, one individual apprenticed as an electrician or plumber when they're 18, 19. By the time they're 25, they're probably making decent money. They may own a house because they don't have the university debt that, let's say, the second person in my example had, who comes out with a Bachelor of Arts degree in sociology or criminology or something. And they've gone to a high-priced U.S. state university. They're probably 24, maybe when they've graduated, if they took their time. So they could be 24, 25, have 6 figures in debt from university, and just be starting careers. So they're not going to be making a heck of a lot of money. And depending on the program that they were in, there's a possibility that, again, stereotyping, that they're brewing coffee at Starbucks as opposed to being in the profession of their choice just because supply and demand on careers. And then again, you contrast that with person number 3 who maybe went to med school. Maybe they got their Bachelor of Science first, 4 years, and then they went to med school, and then they interned. Maybe they specialized. They might not actually be coming out of school and starting to earn until their early 30s. And there's probably hefty debt associated with that too. So you can't just say, okay, 100 minus 25, 75% of your assets should be in equities, because people are at different phases of their life at different times. So if we look at it from a life cycle phase view of wealth accumulation, accumulation phase is early in your career. And if your key goal is retirement, you'll have typically a long-term time horizon, whether you apprenticed as an electrician or you went to med school. You're 20 or you're 30, you still got a significant time horizon till retirement. And you'll also have a lot of short and medium-term goals too, but let's say the big one is retirement or even death. Your net worth is going to be small. It'll possibly be negative, especially if you've incurred a lot of university debt. Your focus in that accumulation phase is probably on liquidity. We talked about that earlier. The emergency funds, the reserves, 3 to 6 months in liquid assets in case you lose your job or something like that where you need liquid cash. You probably want to have money earmarked for near-term goals. Maybe in the accumulation phase, you'd like to buy a house in the next 3 to 5 years. Maybe you need a new car after getting out of university so that you can get to work. These sort of things. And maybe you should consider starting to invest, even though you probably have very little positive cash flow. So that's the accumulation phase, early in the career. And it doesn't matter if you apprenticed as an electrician and that accumulation phase started when you're 20, or if you went to med school or postdoctorate or something and it's not till your early 30s that you're entering this phase. In the mid to late stages of your career, for your typical person, let's say that's 40 to 50, consolidation. There's less time until retirement, but it's still quite lengthy. If you're 40, still 25 years until 65. Your debt load's been reduced, probably properly managed. Your monthly cash inflows are going to exceed your outflows. And this is the area or the phase of life where you can get into serious investing. You've got that excess cash. Now's the time to put it away. And you still got that 25-year time horizon that can add significant growth. Then you get into the spending phase. That's at retirement. Your debt is gone. But also your employment is probably gone, or you've sold your business. So your income is going to come from your investments, your private or corporate pensions. The issue here for me with a lot of investors is that, let's say you're 65, that you retire. Now, it used to be in the old days that people, when they retired, they basically liquidated their assets, turned everything into bonds or cash, so they had that liquidity and they got the annuities or the cash flow from the bonds, maybe some dividends. But in today's world, if you retire at 65, and some people retire even sooner, your life expectancy is probably still another 20 years, give or take. You run the risk, especially if there's inflation on the forecast, that by going into safe, secure, low risk, and hence low return investments, you still need 20 years to have that money. What ends up happening is you've actually still got to look at keeping a portion of your assets in quote unquote risky assets, equities, to have that growth potential, because 20 years is a long time. The final stages of life will be kind of your gifting phase. Here your assets are greater than you need, so you turn to things like family. Maybe you're going to finance child or grandchild's house. Philanthropy. That's becoming more and more of a big area for retirees and people. It's, okay, our kids are fine. What sort of benefit can we do for society or our university or these sort of things? You see people like the Bill Gates and the Warren Buffett setting up their own trusts. And that's also popular on a smaller scale. And that's something that a lot of family offices get into. And even in Saskatchewan here, I know of a couple of companies that do, as their business model, philanthropy. So again, it's becoming a more popular area. But the key here is, don't get fixated on the fact that I'm 20 years old, or I'm 30 years old, or I'm 40 years old. And that's the time that I have, and retirement being the other side. You have to look at where you are in the phase of the life cycle for your timing, as far as your debt, your cash flows, these sort of things. And that's probably more important to consider in your investor profile than just your age. That's all I really want to talk about time horizon. We've covered that in many of our previous subject areas, and we'll cover it again in many more, because time is crucial. But it needs to be factored into your investor profile. And more so, the phase of your life cycle is what's more important than your actual age. And that's especially true in the future when you review your portfolio and you review your investor policy statement and you review your profile, because that's where the changes in your life, the material changes, are going to hit more so than age. And that's what's going to drive adjusting your investor profile, which in turn will cause the modifications in your target asset allocation and your investments themselves. So don't forget about your life cycle phase. That's probably more important than your age when you're looking at investor profiles. Thank you again for your time. Have yourself a good day.